I have been preaching on this channel that not all markets are the same. Some move very smoothly, others are choppy. Some move fast, others barely move at all. But what if you could know exactly what market you are in before placing your trade? That will give you a huge edge over the other traders who are placing their trades randomly. You see, most traders apply the same strategy rules in every market regime, only to see their strategy fail when the market shifts into a new regime. That's why today we are breaking down market regimes, a powerful way to categorize each market on every time frame. By the end of this video, you will understand what market regime is, how to identify them and use them to your benefit, how different strategies perform in each market regime, and finally, how to build your own market regime indicators. First, let's identify what market regime is. Market regime is a way to classify any market on any time frame based on direction and volatility. Let's look at this chart of the S&P 500. By looking at this chart, we can clearly see that we are in an uptrend. Now I can also bring a trend line here, and I can see that we are in an uptrend. I can also say that we are doing higher highs, higher lows, so that also means we are in an uptrend. Also, I can identify some pockets where the volatility is high. For example, here, the volatility is very high. Look at these ranges. And also fully down day, fully up day. This one is the same. While this area is very low volatility. You can see we are very smoothly churning up. Again, here we can see high volatility, big gaps, big ranges. Now, if I zoom in on this chart, I can say, well, here we are in a downtrend and here we are in an uptrend. So direction is highly dependable on the window that you are measuring. So if I'm measuring 10 days, then this is definitely a downtrend and an uptrend. But if I'm measuring 100 days, then this is definitely an uptrend. There is no downtrend. Regardless of the window you pick for the trend or for the direction, by having fixed rules on what is up and what is down, what is sideways, you can build those inside your platform and then use it to define the market. So there is no subjectivity or ambiguity in picking a trend line or higher high, higher lows. It's not subjective. That's it. You have certain rules. We are in an uptrend, we are in a downtrend, and so on and so forth. So based on that, we can categorize any market into 6 regimes. So here is a chart to illustrate that. You see we have volatility, which is either high or low, and we have direction, which is either up, sideways, or down. And by mixing these two, we get 6 categories. So we can either be in an uptrend with high volatility or a uptrend with low volatility, sideways with high volatility or with low volatility, and downtrend with high volatility or downtrend with low volatility. Now, I put here other naming conventions. So uptrend is bull market, downtrend is bear market. It's up to you what you call them, and you get these market regimes. Now, also, you can divide this in more ways. So, for example, instead of uptrend, I can have strong uptrend or weak uptrend. And in downtrend, I can have the same. So then I can have 5 directions. Also with volatility, I can have high, low, medium, and quiet. I can have 4 volatility. So if I use that categorization, then I can have up to 20 market regimes. But from my experience, 6 market regimes are the sweet spot to categorize any market on any time frame. And here are market regime indicators in action. So this is the same chart as the S&P 500 index. And here I have the direction, and below it, I have the volatility. So green means we are in an uptrend, bull market. Yellow means we are in a sideways market. And red means we are in a downtrend bear market. For the volatility, red means we are in a high volatility, and green means we are in a low volatility, and yellow means we are in a normal volatility regime. Now, you can combine these two to have high and low. Now the indicator here also shows velocity. So for example, here we are in an uptrend but going up. That means the trend is getting stronger. And of course, when it's down, that means it's getting weaker. Same thing for the volatility. We are in high volatility and it's getting bigger. And here we are in low volatility and getting smaller. Now in this video, we are focusing on the 6 market regimes and we will leave velocity out of it. This is to simplify the concept so you can use it in your own strategy. And now I added the categorization using this indicator. So this indicator is a combination of these two. So remember, we have 6 categories. So the bright green, that means we are in a bull market and high volatility. The dark green, that means we are in a bull market and low volatility. And here we can see the red one, that means we are in a bear market, high volatility. And the dark red, we are in a bear market, low volatility. And finally, I have the sideways market, which is yellow. That means we are in sideways market, high volatility, and the blue is the sideways market, low volatility. Now, the colors are just for illustrations. Of course, we have the code built in, so there is no subjectivity or you make a mistake maybe by looking at the chart. It's a logic built in the strategy that we can use to identify what regime we are in. Now, to prove the importance of market regimes and the edge that you can gain over other traders by implementing this methodology, we will test it with a strategy. I will be using the classic RSI strategy. Now, I did a full video on this strategy recently, and the link will be in the description. The strategy is extremely simple. The entry is when the RSI with the look back of 2 period goes below 25, we go long. We exit when the RSI with the look back of 2 period go above 65. Now, if this condition doesn't happen within 6 bars, we exit. Hence, we have this exit. When we are in a trade for more than 5 bars, we will exit. So this is kind of a protection if this doesn't happen. So here, for example, the RSI2 strategy applied to only go long when we are in a bull volatile regime and no trades here. So this trade was open in this market regime and then closed here. Same thing here, same thing here. To test the effect of market regime on the RSI strategy, we will first establish the base strategy. So it's the classic RSI2, we'll get all the figures, and then we will test the strategy in each market regime separately. And we will collect the data to see if there are any differences and if there are any effects of the regime on the strategy. So these are the statistics for the RSI2 strategy on the S&P 500 using the futures daily session with historical data of about 18.5 years. So focusing on these metrics, our net profit is 241,000, return to drawdown 6.4, profit factor, number of trades, win rate, average trade, and exposure. Exposure measures the time that we are spending in the market. And here I have this important ratio, return to exposure. This is important because in order to compare different strategies that they spend different time in the market, we need to actually normalize the profit so we can compare them. The way to do this is like this. We divide the net profit by the exposure by the historical data. So in this case, I have 18.4 years, and that gives me about 39,904. So what this means is if I am invested 100% of the time in the market, this is what I expect at the end of every year. So this way I can easily compare it with different strategies that maybe have less number of trades, and of course they have different exposure and so on and so forth. Now let's look at our first market regime, the bull volatile. So in bull volatile, we are making 74,000 net profit, lower drawdown, higher profit factor, of course lower number of trades because this is using all data, higher win rate, higher average trade, and lower exposure. Now, yes, here we have lower net profit, lower number of trades, and lower exposure. But if I use this equation again here, we can see that this strategy is producing better returns if I take the exposure into the equation. And that's why I did this, so we can easily compare. And then below this, I have the comparison to the base. So here, the number of time that this market regime exists. So out of the full data, the 18.4 years, 25.5 was spent in bull volatile market regime. And then the next metric is the improvements over the base. So this is the percent improvement of return to exposure metric. So basically I'm measuring this metric compared to this, and we are 26% better. Then this one, the improvement of return to drawdown. I am measuring this metric compared to this, and obviously we are lower, so we are 44% low. Then this one is measuring the profit factor improvement, and in this case, this is 2.2, this is 1.8, so I am 22% better. Then we have the win percent, 76.2 over 74.4, so that's 2% better. And finally, the average trade improvement. Here we have 705, here we have 567, so it's a 24% improvement. Now, I did this for all market regimes. So bull quiet, sideways volatile quiet, bear volatile, and bear quiet. And these shows the better or worse than our original strategy. And of course, you can clearly see now that the strategy doesn't behave the same in all market regimes. Immediately, this attracts your attention. The sideways volatile market, everything is worse than the original strategy. So even though it's profitable, the strategy is profitable in this market regime. It's producing $255 on average per trade, but it's a lot worse than our original strategy. And then we have the bull quiet regime. Again, it's performing worse than the original strategy. On the opposite side, we can see bull volatile producing better results, sideways quiet producing better results, and bear volatile producing better results. Now you can say that these last two, the bear volatile and bear quiet, have mixed results, and that's totally okay. And that's what I did here. So here I combined 4 market regimes. So I excluded the bull quiet regime, which is this one. I also excluded the sideways volatile market regime, which is this one. So these two are excluded. When I exclude these two, so that means I'm using 55% of the total data. And these are my results. And the results are very good, except for the return to drawdown. But everything else is much better. Now here is another test where I exclude the bull quiet, the sideways volatile, and also the bear volatile. And I get these results. So I'm using 47% of the full data. This is not the exposure. This is the exposure, 16% in the market. And then these are all my metrics that are better than the original. Also, you can easily tell from using our return to exposure that these are definitely performing better than the original. So this is a great insight for your strategy to see the behavior in each market regime. And as you can see, it's not the same. In fact, it's totally different. It's wildly different in every market regime. Now, this data will be different for every strategy. So the RSI2 strategy behaved this way in these market regimes. If you come up with a new mean reversion strategy, although the behavior will be correlated, but it will be different. But the idea is now you have a deep inside look into your strategy behavior in every market regime, and you can respond based on that. For example, you can switch your strategy off in that market regime, and that is basically a strategy filter, or you can change your position sizing in that market regime. Now let's take it a step further. The US indexes, the NASDAQ 100, the S&P 500, and the Dow Jones 30 are highly correlated stock indexes. So here is a chart with the correlation. The candlesticks at the top is the S&P 500 index, And the blue line is the correlation with the Dow Jones 30, and the orange line is the correlation with the Nasdaq 100. Now, if you don't know, when the correlations is high, that means both instruments are moving in tandem. Basically, they are going up and down the same way. And when the correlation goes to -1, that means they are moving opposite to each other. Now, of course, if I zoom in, for example, here, we can see that the Nasdaq went to 0 and then went up again. The Dow Jones here went to 0, went up again. So this is over a couple of days. If I zoom out, you can see that we're spending most of the time at the top, at 1. So that means that the S&P 500, the Dow Jones, and the Nasdaq are highly correlated. And I can actually go further in history. Look at this. The blue line never dips below 0. I mean, this is barely. And the Nasdaq maybe sometimes reaches 0.5, but it never happens. And this is going back further and further in history, 1964 and so on and so forth. So the correlations are extremely high, and they are always high. Like they usually dip very briefly and they go back up. So we expect the behavior of market regime to be the same on the same strategy. But of course, we need to test to validate the theory. So here is the test of the RSI-2 strategy on Nasdaq. Remember, this is the same strategy. RSI-2 below 25, we go long. RSI-2 above 65, we exit. Or if we are in the trade for more than 5 bars, we exit. So it's the same strategy. We're just applying it now to Nasdaq futures. So this is our original strategy, and these are the figures for all the market regimes. And again, here I use filters. So these figures do not use the bear quiet market regime. And as you can see, I didn't use it because it's all red. That means the strategy is the worst in this market regime. All metrics are worse than our original strategy. I did another one here where I excluded the bear quiet market regime and the bull quiet market regime. And again, these are the metrics. And as you can see, this time we are using only 50% of the data. We are only 20% in the market, and our figures are amazing. All the figures are better than the original strategy. I did the same test for the Dow Jones 30. This is the original strategy. Again, it's the same strategy. I did the market regimes. And here I excluded 2 market regimes. I excluded the bull volatile market regime and the bull quiet. So basically, I excluded these 2 market regimes. And of course, you can see why, because this is all performing worse. And also this one, although you can see it's yellow, but these are all minus. And then I did another one where I added to these 2 the bear volatile market regime, which is this one. And these are the figures. And as you can see here, I'm using 40% of the data and 31% of the data. The exposure is very low, and all figures are better than the original. So same strategy on highly correlated instrument using the same categorization performs differently in each market regime, which is not straightforward conclusion, because you would think, I mean, they are highly correlated, so I expect the same strategy to behave the same in the same market regime, but they are not. So looking at them closely, this is the S&P 500 futures, this is the Nasdaq futures, and this is the Dow Jones futures. And the worst market regime for the RSI-2 classic strategy is the sideways volatile here, and it's the bear quiet in Nasdaq, and it's the bull volatile in the Dow Jones. The best performing market regime is the sideways quiet for the S&P 500, the bear volatile for the Nasdaq, and the sideways quiet for the Dow Jones. So here, at least we have the same market regime that the strategy behaved the best in. And that is what I want to drive home, is that market categorization is different for every market, even if it's highly correlated. So you always need to test your strategy on that market using this market categorization. Now, my market regime indicators are fixed. I mean, you cannot change the window look back. Now, I know you can see here many variables for input, but that's only for text to output the statistics. So if I switch it on, you can see it shows these statistics for this indicator for this instrument. These two indicators are only available for the Algo Trading Masterclass students. But in this video, I will show you how you can build your own market regime indicators. So for you to implement market regime, the simplest way is to get rid of these two. So you will have 4 market regimes. And to implement this, we will use the moving average for direction. So for direction, moving average. And for volatility, we will use the average true range. The reason is these indicators are available in any platform, free or paid, and they are very easy to code in any language. And here are the rules. If the average of the past 30 bars greater than the average of the past 144 bars, we will consider the market is in an uptrend. And if it's not, then we are in a downtrend. For volatility, if the average true range of the past 13 bars is greater than the average true range of the past 55 bars, then we are in a high volatile market. If not, then we are in a low volatile market. So using those categorization, we will have 4 market regimes. It's up or bull, high volatility or low volatility, and down, high volatility or low volatility. Now you might ask, why these numbers? So there is actually, I didn't do any optimization. Now there is no magic in Fibonacci numbers. I just tried to appease my fellow Fibonacci traders. And actually in reality, it's just to make it unique. That's it. That's the only reason. And you can pick any 2 numbers with 2 in between. So if you pick the start as 3, then the next one should be 21. So I pick, for example, 13. That's why the next one is 55. And here I pick 34 and 144. And as you can see, 34 is here. So the next one is 144. So if you pick 89, then the next one will be 377. That will not make it better or worse. It will just make it different. In general, if you always put 2 numbers between the beginning and the end, most likely you will end up with a good market regime. And here are the results of our new market regime. So remember, we are still using our original strategy on the same market, on the same historical data. So of course, these will be the same numbers. But here now our new market regimes data. So we have only 4 of them and they produce different results, which is good. That's what we want. Exposure is totally different. And this shows the amount of data for each market regime using the full data history, which is 18.5 years. And we can see that the bear market is about 25% of the time from the full data. The worst strategy performance is in the bull volatile regime and also the bull quiet regime. And I exclude both of them here. And you can see these are the numbers by excluding these 2 market regimes. And you can see that our return to exposure is extremely high, 65% better than our original strategy. So this is an excellent start for you to categorize any market you want to trade. And of course, this will work on any market, any time frame. Even if you are trading intraday, hourly, minutes, it doesn't matter because the calculations are still going to be there and you can categorize that market on that time frame that you are trading. Now, the only caveat is the indicators that I showed you that you can use in your own trading are type of dictatorship. So if the moving averages are above, you are in bull market. If it's below, you are in bear market. There is no gray area. So it's like dictatorship. Now, still, that doesn't diminish the value because like I showed you, the strategy does behave differently in each market regime. But the way I built my market regime indicators for the Algo Trading Masterclass students is with a democratic behavior. Basically, I have many signals, and if enough of them vote that the direction is up, then the direction indicator will be up. And if enough signals vote that the direction is down, then the market indicator will point down. And if there is a mixed vote between up and down, then I will get the sideways indicator. So it's a different way of building the indicator. Of course, I believe mine is better, but it's still better than using nothing. You should use the moving average and the ATR, just like I showed you, to categorize your market. In conclusion, market regimes are one of the best way to categorize a market that you are trading and to see how your strategy behave in this market. You can use it in many ways, and especially to exclude high risk periods in your strategy. If you like this video, then you will love the next one.